Hi, this is Peter Dorman, Financial Markets. Let me begin by saying what I'm not going to tell you. I'm not going to explain to you how you can play the markets and make lots of money. It's not because I don't want you to get rich, it's just not the topic for today. Rather, I'm interested in how financial markets are a part of the larger economic system, what role they play, and the difficulties that economists have faced in trying to understand the operation of these markets and what implications they have for the way our economies work. Let's begin with the central conundrum that defines the problem of capital, really, which is that capital can take two different forms. It's, in a sense, two different things. On the one hand, we have real, what you might call real capital. So real capital is stuff that in some way is productive. These are things that people own, so it's capital, and it's productive. So it could be equipment, could be natural resources, it could be intellectual property that somebody might own and could be productive. These are actual things, and if you were to describe that capital, it would take the form of a list, a very long list of specific things that do perform specific services in production. But at the same time, there's another rather different conception of capital, which is simply a sum of money. If you were to say, I want to start a business and so I need some capital, what you're really saying is not that you need, or it's not only that you need like some equipment or you need some resources. What you're really saying is you need some money so that you can run out and buy these various things or pay yourself a salary for a few months until the revenue starts coming in. That's what you mean by capital. You mean a sum of money. Now, the problem is, what's the relationship between this long list of goods that are productive in society, if you will, the phenomenological understanding of capital, and the notion of capital simply as a sum of money, as a sum of so-called value? Well, it turns out economists have not solved that problem. And in fact, there may be no solution to that problem. I know that's sort of frustrating to hear, but I'll explain in a bit why maybe it isn't frustrating, but reflects something in the real world. The simplest way to approach it, I think, is by a metric called Tobin's Q. Tobin is named after Jim Tobin, a Nobel Prize-winning economist who proposed the idea of having a measurement of the ratio of the market capitalization of a company to its book value. So the market capitalization is the market value set in the stock market of all the outstanding shares of the company. So if you wanted to purchase 100% of that company by buying all the shares that are out there in the market of that company, this is how much you would have to pay to buy 100%. The book value is the value of all the assets of the company if you were to sell them off one at a time. So it's some notion, this kind of combines the two different notions of capital in some way. The market capitalization is the money concept of capital. That's how much money is this company worth. The book value concept of capital is the phenomenological value, that is the value of all the different items that the company owns added up. Typically, this ratio is not 1. In fact, it's pretty much never 1. Ideally, the market cap should be higher than the book value if the company is adding value to its assets by what it does with those assets. If you look at it from that point of view, there's no reason why there should be any necessary relationship between the market value of a company and its book value. Now, given the fact that economists don't understand it, it still remains a fact that markets allocate capital investment. That is, the actual production and allocation of capital resources in the country, of equipment, of trucks, of buildings, of machinery of all types, of research and development departments and corporations. And all these things, these very specific activities are allocated. They are financed or not financed. They're directed to one use or another use in one location or another location by markets in financial capital. So a conundrum of great importance for understanding how a capitalist economy works. To make progress on it, we have to understand that there are different financial markets that address different aspects of capital. The one we often think of first is the stock market, or what economists would call equity markets. And this includes initial public offerings. So when people turn their business into a corporation and they initially sell shares of stock, they take in money for that through the IPO. As firms make announcements of changes in their investment plans, or as new information comes in about the performance of these firms, their stock prices fluctuate, and this sends a signal to how those who are buying and selling financial capital regard the real operations of firms. Credit markets are also extremely important, however. Credit markets are markets in debt instruments. A debt instrument is essentially an IOU. Somebody borrows money, and there's a piece of paper saying they promise to pay it back. That's an IOU, and those IOUs are traded in credit markets. There, the critical issue is the risk of non-repayment by the borrower. So it's perceptions of risk that drive credit markets. And that's a very important aspect of the performance of companies. How much risk are they bearing? How much risk do we see that perhaps their performance will deteriorate in the future compared to where it is today? Credit markets are putting a price on that. Finally, we have commodity markets, and commodity markets are markets in resources like grain or like certain metals. Other agricultural or livestock products. These financial markets these markets are important not only for their immediate impact on the prices that resource owners or farmers get for their products, but also because they have developed into fairly complicated instruments to assess risks in the future, possibilities of combining or disentangling different activities. There are different ways in which these markets price different aspects of the use of natural resources. And that too has a huge impact on how our economy operates. So why do we care about these things? What we really care about is whether, well, there are two big issues. One is the metric that these markets use is financial return. That, in the end, is what they're trading. They're trading the opportunity to take part in capturing some of the revenue stream of a corporation. But a deep question is whether that revenue stream, the size of it, corresponds to the actual social and economic benefit of what the corporation is doing. Most economists just assume the answer is yes, and they assume that because of the market welfare model that we already looked at. However, in the real world, the answer is at best maybe, that in some cases there is a relationship. Sometimes a firm is financially rewarded for doing something very good for society. But in many cases, firms are financially rewarded for things that are suicidal for society. So one has to pay attention. And the second thing, of course, is the operation of the markets themselves. That is, what are the dynamics of financial markets? Are they rational, these markets? Do they encourage common sense and clear thinking, or do they encourage herd behavior and irrationality? We'll get back to that in a moment. Default is also a very important aspect of how financial markets work, and the risk of default. It's important to understand how default works. Default may be triggered by what we might call a liquidity crunch, that is a cash shortage. So you have cash coming in, you have cash obligations to pay, and there might come a moment in time when you don't have enough coming in to make the payments you need. There isn't enough revenue coming in to pay your workforce or to pay the people that you've bought things from on consignment or whatever. That would be a cash crunch. Now, a cash crunch does not have to lead to a default, because all you need to do is to borrow money in order to get past that crunch. And, well, you should be able to borrow the money if you're otherwise in a good position. If it's just at the moment there isn't enough cash, then you should be able to find a lender who will lend you the cash. However, if you are insolvent, you will probably not be able to borrow that money. An insolvency exists when your liabilities exceed your assets. What the firm owns is less than what the firm owes. Even if it could sell off everything that it owns, it still wouldn't have enough money. So in that situation, the only solution is default. Now, once upon a time, individuals who went into default were thrown in jail because they had violated their sacred promises to people, so they had to be punished, and that was the debtor's prison. However, today we don't have debtor's prisons so often. We do for poor people in some cases, and that's another story, but for the business world, we don't. Debtors are now, debting corporations or defaulting corporations are placed under court protection. What that means is that the court protects the defaulting corporation from the claims of its creditors, but in return for that, the owners of that corporation give up control, and the court assumes the control, which it can either exercise directly or it can set up some group of creditors to run the corporation. And under this new management, the corporation may continue to function if the court deems it desirable in order to generate revenue to pay off creditors. Or the court may decide simply to liquidate the enterprise, sell off all of its assets, and use the proceeds to pay off as much of the creditors as possible. Default is an extremely important part of a capitalist economy, and it's become more important because default is now used strategically by corporations. They plan. Default is one of the planned options. You know, like if this happens, we do this. If that happens, well, I guess we default. And so they just figured it in as a cost of doing business. Countries around the world differ in how much leeway they give financial markets to regulate their economies. And we distinguish between what are called market-centered and institution-centered versions of capitalism. So in a market-centered system, companies, the stock of publicly traded companies are traded primarily in the stock market, as we normally think of it. And so it is the buying and selling of stock that determines who owns the company at any point in time, what the value of the company is, and then as we saw, in theory, the shareholders have control over the board of directors, et cetera, et cetera. In an institution-centered economy, by contrast, typically banks play a prominent role in the ownership of stocks, and they typically don't trade those stocks. So a particular bank is associated with a particular company. It sits on a large share of the shares of that stock and maintains deep hooks into the management of that company. So it's the decisions of the company are less responsive to the stock market and more responsive to this bank. From the standpoint of where the money comes in, especially, where do companies get their money for investment? In a market-centered system, companies either self-finance investment, that is, they finance investment out of profits, or they issue bonds. In an institution-centered system, typically most of the investment is financed by the bank, which has a deep relationship to that company. And it can take different forms. It could take the form of a sale of bonds, but the bonds are sold specifically to that bank. It's kind of a private deal, and isn't funneled through a market. Typically, this distinction between market-centered and institution-centered corresponds to shareholder versus stakeholder-oriented systems. So in a market system, usually it's the interests of profit that come first. In an institution-centered system, typically the banks desire profit, but are not only about profit, they also have some kind of system-level concern. So they might be interested in collaborating with the government over certain objectives, or they might be interested in the workforce and keeping employment up. They have different objectives. And it really, of course, then depends on the banks and whose interests the banks serve which can change over time and changes from one country to another. Examples. Market-centered is typically the Anglo-Saxon countries. The United States, England, mostly Canada, Australia, New Zealand. The classic cases of the institution-centered economies are Germany and Japan. Broadly speaking, other European countries vary in between these two poles, but drift more towards the institution-centered than the market-centered. The European Union has been systematically trying to dismantle the institution-centered structures of Europe and replace them with market-centered structures. So, let's get to the point. Are financial markets efficient, effective, socially desirable mechanisms for making fundamental decisions about what gets produced, where the investment goes, and so on? So we have the efficient market hypothesis. The hypothesis is that market prices reflect all the available information. So all the information that's out there, that anybody could possibly have about the future, about the value of different investments, about the state of competition, about what consumers want or need, or what they will want or need, anything that could possibly affect an investment, all that information is reflected in market prices. No single individual has that information, but if you take the entire market together, that information is distributed among the market participants, and the market price reflects the input of all that information. Now, if that were true, changes in market prices should be unpredictable. And the reason is that prices would only change if there was new information. And by definition, new information is new. It's not predictable. If it were predictable, it wouldn't be new. So if there's randomness or unpredictability in life, which there is, then that would be reflected in randomness and unpredictability of market prices. Now, are market prices really unpredictable? Well, almost. We know they're close to being unpredictable because if they weren't, there'd be some people who would be getting fabulously rich by predicting them, and then other people would find out what their methods were and copy them, and then there it would go. So no, they are mostly unpredictable, although there are certain patterns that people can see, the January, bump or something like this. But for the most part, the prices are unpredictable. Now, that's important to know because it means that if you're somebody with some money and you pay money to some Wall Street guru or brokerage house to manage your money for you, you're probably throwing your money away because if price changes are unpredictable, they can't predict it either. So any fees that you pay them are simply money down the drain. And the investment advice is to buy an index that covers all the stocks, like this S&P 500. Just buy that index and forget about it. Just let the index do whatever it does. That's pretty close to what Warren Buffett, for instance, recommends for investment. Not quite, but pretty close. But market efficiency from a social point of view is not the same as simply the unpredictability of markets. Because from a social point of view, we care not just about unpredictability, but whether the purposes that are served by those market prices are social purposes. And even at a more simple level, we're concerned with the rationality and consistency of the market in terms of its internal dynamics. And here we can turn to this guy, John Maynard Keynes. And John Maynard Keynes described a financial market as being similar to a beauty contest, where the prize goes to the judge who best predicts the votes of the other judges. So in that case, it's guaranteed to have herd behavior. People are not looking for the winner, the true winner of the contest, but they're looking for the person who's most likely to be regarded as the winner by other people who are in the market. And in that case, you're going to see the market with wild swings where people are trying to predict the herd movement and join the herd before the herd knows that it's a herd. That leads to essentially the function of a casino, where markets swing one way and another way with little rational underpinnings. So Keynes' conclusion was when the capital development of a country becomes a byproduct of the activities of a casino, the job is likely to be ill done.